Hello, my name is Paul Ciarcia. I'm a graduating senior at the University of Denver studying finance and psychology. The study of these subjects has influenced my interest in examining how societal trends influence the markets we operate within. More specifically, how COVID-19 has changed the way we interact with real estate, therefore resulting in changing practices for real estate investment trusts. This research was completed with the guidance of Khindanova, teaching associate professor at the Ryman School of Finance. This paper first introduces the REIT industry to identify the reasons for its historic success and continues to analyze various trends that have been initiated by COVID-19, which have caused harm or created opportunity for investors. From these trends, 4 sectors of REIT investment have been identified as potential long-term opportunities. We will begin by examining the current state of REIT investment. Historically, real estate investment trusts have been a reliable and often lucrative investment class that provides shareholders with steady dividend payments. However, COVID-19 has brought about a challenge that has not been seen in over a century, when the Spanish flu ravaged the globe. One in which the density of office, retail, and urban spaces have become a real life or death hazard for millions of people. This meant that the financial benefits of being in densely populated areas now became a strict liability. This has led for heavy losses in sectors like retail, office space, and lodging, and also suggests medium to long-term changes in the demand for various real estate classes. By examining these trends, this paper aims to develop new strategies for REIT investment to ensure it remains a profitable and reliable industry. The 4 sectors identified are data center, cell tower, warehouse, and healthcare REITs. These findings will be useful in helping investors to identify new investment strategies, navigate the changing trends, as well as provide some insight for new investors who are looking to enter the REIT industry. The REIT industry began during the Eisenhower administration as a way to incorporate everyday Americans into real estate investment. In their simplest form, REITs are companies that maintain portfolios of properties that often specialize around a specific sector, like office spaces, for example. These companies utilize investor capital to purchase and operate their properties, then redistribute the rent they collect through dividend payments. Real estate investment trust lowers the barrier to entry by allowing investors with limited capital to invest in a market that typically requires previously accumulated wealth. Today, 43% of American households hold shares in REITs, whether directly or indirectly through investment portfolios. REITs have strict requirements on the assets in their portfolios, with at least 75% needing to be in the form of real estate, cash, or treasury bonds, while 90% of their taxable income must be paid out to shareholders in the form of dividends. Because of their low correlation with the stock market, low standard deviation, and high return for long-term investing periods, REITs have garnered a reputation as a reliable investment able to withstand turbulence in the market. For example, REITs managed to survive the 2008-2009 recession with an average return of 3.43, compared to the return of negative 2.47 for the overall stock market. Over time, this American model of real estate investment has spread on a global level, with over 36 countries with current REIT legislation, and the numbers continue to rise, with major players like India and China beginning to introduce REITs to their markets. China alone is one day predicted to be a $3 trillion real estate market. In order to capitalize on the future of REITs, investors will need to understand how COVID-19 has impacted the industry, with 2020 bringing in record losses for many industries. Notably, industries like office, retail, residential, and lodging REITs were hit extremely hard by policies meant to enforce physical distancing, while industrial, self-storage, timber, infrastructure, and data center REITs showed how their services are more constant and may even be benefited by the changes needed to keep people safe in the pandemic. In order to determine what the future holds for REITs, it will be important to analyze and predict the future prevalence of trends like remote work and online shopping. Following lockdown, many corporations have had to abandon their office spaces indefinitely, with many companies still not returned to the office over a year after the initial lockdown. However, many of these companies are still stuck in pricey long-term leases. Combining these massive sunken costs with the realized benefits and employee satisfaction of work from home, it is likely that more companies will transition to majority remote work. In fact, it is estimated that 25 to 30% of the workforce will be working from home at least part-time by the end of 2021, with the potential for these numbers to be much higher. On top of corporations transitioning to remote work, COVID-19 has created astounding growth in digital services, with companies like Amazon nearly tripling their profit over the course of their pandemic, and their web services operating income increasing by 56%. Facebook, Alphabet, and Microsoft all experienced massive growth in revenue, with the common thread being their web-based services. On the other hand, the risk of contracting COVID-19 has made popular shopping malls and stores a health risk and forced them to switch to online delivery or close down altogether. Even before the pandemic, retailers were facing struggles amid the rising prevalence of online shopping. The combination of remote work advantages and the proliferation of online retail and services suggests heavy losses for companies and investors that have capital tied up in large office spaces and malls, while simultaneously exposing opportunities in the digital services area. Based on these trends, it is recommended that real estate investors redirect their assets to REIT classes that support the rise in remote work and online shopping, specifically data center, cell tower, warehouse, and healthcare REITs. Current data center REITs that are available to investors include Equinix, Digital Realty, CyrusOne, CoreSite, and more. A promising opportunity for lower income investors is CyrusOne Incorporated, which currently operates 50 data centers across the globe. Over the course of 2020, CyrusOne increased their share prices by 11.74%. And are currently trading at $74.29 per share. Additionally, the company has acquired many new developments in key areas like London, Frankfurt, San Antonio, and Phoenix, which suggests further increases in their funds from operations and share prices. Although share prices of many data center REITs have come down from their 52-week highs in June and July of 2020, these companies will be pressured to meet the demand for increasing amounts of data usage and services. Therefore, their long-term outlook remains stable. The second sector are cell tower or infrastructure REITs, which have emerged as a promising investment as demand for cloud computing and 5G capabilities increases. In 2020, cell towers grew their returns by an average of 19.7%. Compared to a 15.76% return for the S&P 500. Current dominant cell tower REITs include American Tower, Crown Castle International, and SBA Communications. For the college budget investor, Unity Group, a company specializing in communications infrastructure, shows promising signs of growth as well as high accessibility due to its low price per share. At just $10.96 as of April 24, 2021, these share prices may reflect a mispricing that has been influenced by one of their tenants filing for bankruptcy, as well as the recent opportunity to reissue their debt at market rates. With these developments being resolved, Unity is expected to grow in the coming months. With the company currently experiencing a small dip in share prices, now would be a good time to buy. Warehouse REITs have been positively impacted by the rise of online shopping and subsequent fall in brick-and-mortar retail. Things like warehouses, distribution centers, and manufacturing plants are all needed in increasing quantities in order to meet the growing amounts of online orders. From 2019 to 2020, leasing activity for industrial real estate rose 26.9%, with e-commerce being the main driver of growth. This growth equates to adding 5,698 football fields of new warehouse space. One promising opportunity for new REIT investors is Prologis, America's largest owner and operator of industrial facilities, as well as Amazon's largest property owner. With other tenants like Home Depot, Walmart, UPS, and FedEx, Prologis is a global player with over 620 million square feet of warehouse space in the United States alone. Having tenants that have such power over the economy, Prologis shows long-term promise for investors looking to cash in on consistent dividend payments. With shares of this company trading at an all-time high of $114.87, it is not a recommended time to buy. However, it is recommended that you keep a close eye on Prologis and invest when shares reach a pullback. The final sector of REIT that is expected to grow following COVID-19 is the healthcare sector, which averaged returns of 15.7% between 2000 and 2020, compared to an average return of 6.1% for the S&P 500 in the same period. These returns are expected to grow in the future due to global demographic shifts, with individuals aged 65 and over on track to outnumber children for the first time in history. The increase in elderly individuals means increased demand for senior care and outpatient facilities, as well as the increased need for healthcare centers that was highlighted by the global struggle to adequately care for COVID-19 patients in hospitals. However, there are also challenges to growth in the healthcare sector. The 9.6% loss in 2020 was a result of the high death rate experienced in nursing homes during COVID-19, increased operating costs associated with additional COVID precautions, and decreased revenue from canceled operations. While there are promising signs for the future of healthcare REITs, investors should be wary of ones that solely focus on senior care facilities, and instead turn their attention to diversified healthcare REITs that own different types of healthcare facilities. One healthcare REIT that shows signs of success is Medical Properties Trust, an international healthcare REIT that focuses on net leasing hospitals. They typically sign 10 to 20-year leases and were able to collect 100% of their rent during 2020. Allowing them to invest in 32 new hospitals across the globe. While Medical Properties Trust has hospital realty covered, investors may also want to invest in a company that is more involved in outpatient services. For this, Ventus Incorporated may be a good choice. Ventus is a well-diversified healthcare REIT that invests in senior living facilities, outpatient clinics, health systems, research centers, and medical offices. In conclusion, the dependence of society on the use of real estate means that although the market may go through cycles, it is not at risk of being phased out like other markets, such as petroleum-fueled cars. It would benefit investors most to buy into the REIT market now, before prices rebound to pre-pandemic levels and even higher. Also, for investors to take advantage of the emerging societal trends that will generate huge growth in data center, cell tower, warehouse, and healthcare REIT sectors.